Hi Fools, David Williamson here, and welcome to Market Checkup, the Motley Fool's healthcare-focused investing show. Let's start with who's winning and who's losing today in the healthcare sector. We have a number of winners in the market, but we're going to focus on just one today, and that's Hansen, the robotic catheter maker. It's up 20%. The company got FDA approval for a new robotic catheter, the Magellan 6FR. It also named a new CEO. Bruce Barclay is on his way out as Chris Lowe moves from the board of directors to the chief executive position on an interim basis. Hopefully the new catheter will keep Hansen's momentum going. Sales did bottom out in the first quarter of 2013 at a measly $2 million. They've grown substantially, but unfortunately a substantial growth from $2 million puts it just over $5 million last quarter. And bottom line, Hansen needs to show more to justify its valuation. I agree with Sean Williams. The company's burn rate and relatively low cash position concern me in regards to dilution, but this is definitely a great day for Hansen investors, and it makes the stock more interesting and one to watch. Now, moving on to our losers, we have two today, and one of them is the largest animal health company in the world, Zoetis. It's down 5% after reporting fourth quarter results that beat analyst estimates at 36 cents per share versus 34 cents. However, 2014 guidance was shy of what the street wants, and shares are getting dinged at a response. At its midpoint, it came in at $1.51 per share in 2014 earnings, which is 10 cents light. Still, Zoetis is in a pretty dominant position, and I do think that investors should take a good look at this company after its sell-off. They're likely being a little more conservative with the guidance than they need to be. Now, finally, we're going to go to Cambrex Corp, which is a stock I've really been highlighting the last couple weeks as I thought it was a really interesting company. It's an API, an active pharmaceutical ingredient maker. It essentially makes the drugs the drug companies sell you. And I really liked its financials, but one of the things that I was saying investors should do is wait until earnings, and that caution was proved right. Shares of Cambrex are down 10% after earnings. There was no, unfortunately, extra clarity as to who its big client is. Rumors have swirled that Cambrex would be making Sovaldi, the hepatitis C medicine, but more importantly, 2014 guidance was lower than estimates. Its fourth quarter was solid, but unfortunately that isn't winning it any favors, but despite beating on both the top and bottom lines, including an impressive 46% surge in revenue. Cambrex is definitely worth digging into. I need to update my model and taking a look at where Cambrex is right now post earnings. I'll probably have that for you in a future version of Market Checkup, but today, unfortunately, shares are selling off. All right, so moving on to our headline segment. Our big headline today is a buyout. Mallinckrodt, which is up 10%, is buying Cadence for $1.3 billion. Shares of Cadence are up 26%. On the news, the target of the acquisition is Cadence's painkiller Affirmev, which was approved in 2010, but it hasn't been a huge seller. Its trailing 12-month sales are roughly $100 million, a little over $100 million. Mallinckrodt believes it can double those sales, which I think it needs to do to help justify this purchase, but there is some bullishness in this drug. Investors on both sides are cheering this move, as Mallinckrodt is saying it should be accretive to diluted earnings this year. Now Mallinckrodt is a specialist in abuse-resistant painkillers. It's a company that's good at reformulation, and its goal has been to grow its specialty pharma business, which may make its diagnostics imaging business expendable in the not-too-distant future. Now, this is a company that was spun out of Covidien last summer under the theory that Mallinckrodt could unlock value on its own, and that theory has proved correct. Shares of Mallinckrodt up 34%, more than doubling Covidien's returns over that time. We've seen a lot of consolidation in spec pharma, and Mallinckrodt is now standing out there as a potential target. So I'm going to watch the company closely. It's definitely an interesting business, and we don't, after all the buyouts, see a whole lot of larger spec pharma companies. So I think this is a company that is worth some foolish attention. So moving on to what would normally be our game segment, but as we're apt to do here at Market Checkup, we're going to switch it out with an Affordable Care Act segment, Obamacare, and we have new news that there will be another delay to the small employer mandate. That's employers with between 50 and 99 employees will now not be recovered to provide them health coverage instead of 2015. And keep in mind, it was already pushed back from 2014, now until 2016. Now, employers that do qualify will have to certify both that they aren't firing workers to get under the 100 worker threshold and that they aren't changing the health benefits they already offer. But if that's the case, they won't have to comply with the Affordable Care Act until 2016. Now, employers with over 100 employees are also getting a change. They only have to cover 70% of their workers in 2015 rather than 95%. Of course, keep in mind, 96% of employers aren't subject to these provisions. These are the large employers. We're only talking about small businesses here. So it is a smaller percentage of the overall employer population. There obviously has been some political fallout from this. However, we're concerned more about the business fallout, and that really does remain to be seen. These aren't necessarily huge employers. While the employee numbers do add up over time, it's not necessarily as significant as the individual market, which we've seen pick up steam with healthcare.gov. Of the companies on that, I would say WellPoint has actually generally been the most successful. We've seen Cigna get a ding on earnings and say they don't expect to make money on the exchanges. We saw Aetna in their recent conference call also say they don't expect to make money in 2014 on the exchanges. WellPoint, however, says it does expect to make money. They have about 500,000 Americans signed up through the company's Blue Cross plans, and thanks to the marketplaces. And this large market share is working well for them. WellPoint specifically went out to capture more of the market than their competitors. We saw a lot of caution from the large insurers. They wanted to dip their toe into the exchange pool. WellPoint really kind of cannonballed right in there, but it appears to be a tactical move that's working out well for them. It remains to be seen, exactly how this plays out over time. But generally, it has been pretty good for WellPoint. As far as the small employer delay, I don't think that's anything investors need to worry about, and we'll leave the political fallout to political commentators. And moving on finally to our watch list segment, what I'm watching right now is the pretty crazy rate of biotech IPOs we've seen already in 2014. Just the other week, we had 8 IPOs raise over $500 million. And we've seen all of the IPOs over the course of 2014, which has been pretty significant. Half are now busted. That means they're trading underneath their IPO price. One of the bigger headlines I would say is Dicerna. It is, in fact, still up. It's up about 5% since its IPO. It raised close to $100 million. It's valued at about $600 million. But when you look at Dicerna's pipeline, not only are they using a somewhat unproven technology, but none of their assets are into phase 1 clinical trials. They're all preclinical. So you're seeing pretty significant valuations for a lot of companies. I don't mean to pick on Dicerna here either. You see this throughout a lot of these more recent biotech IPOs, both this year and last year. And the question is, how long can this continue? How long will investors be interested in paying up for very early developmental stage companies? That's something I'm watching going forward, because I think it also helps take the temperature of where we are in biotech investing. And right now, clearly, there's a lot of interest and a lot of enthusiasm. But if we start seeing these IPOs flag a bit, that's going to leave me to have a little more concern about the broader sector as well. Thanks for watching Market Checkup. Stay tuned to Fool.com for all your healthcare news, and Fool on.